Market sell-off on Friday looks to continue. More importantly, a head and shoulders pattern intact. That's coming up in today's 3 minutes on Markets and Money. On Friday, markets sold off rather sharply as the Fed, didn't pivot as expected. Of course, disappointing markets as the Fed actually suggested they're going to remain much more aggressive in combating inflation, saying specifically that this could lead to slower economic growth, job loss, and these may be necessary in order to bring down the rate of inflation. So again, that lack of a pivot certainly surprised markets on Friday. A big sell-off, the Dow down 1,000 points on Friday on that news. We're now looking to test that 50-day moving average. Now, we've been talking about this for the last couple of weeks, that this rally from the lows had gotten very extended, ran into the 200-day moving average, sold off from there, and we said that there were a couple of levels of key support that the markets needed to hold on to. One was the 20-day, right below that was the 100-day moving average, cut right through that, and now we're sitting here looking to test the 50-day moving average today as the markets open. Going to be down about 1% at the open this morning. A failure there, we're going to be looking at retesting lows. Now, here's an important point of what's going on here. This is part and parcel of this head and shoulders pattern that we've actually been building now for several months. Going back to August, we formed this left shoulder. The head came along right at the end of December and January at the market peak. And then this March rally following the Russia invasion of Ukraine formed that right shoulder, the neckline running right across the top of these peaks. And again, that failure at the 200-day moving average last week was a confirmed failure of both the 200-day moving average and that neckline. This now puts the test of the 50-day moving average and these recent lows very much in focus. A break of those lows is going to set us up potentially for a much lower level in the markets, probably somewhere between 3,000 and 3,200 initially. Again, not a lot of support from these levels once we get below those July lows. This does not mean, of course, that we should just sell everything and move, to the sidelines. Certainly the market is under pressure right now. This failure at the neckline does kind of confirm this head and shoulders pattern, which does suggest lower asset prices, at least in the intermediate term, along with our sell signals, which are very clearly intact now on both our money flow level as well as the MACD level. All these kind of components are lining up, suggesting that A, we're still in a corrective market, B, we're still in this process of this sell-off, and we haven't finished that process at all. And markets are still trying to price in much weaker economic growth. And again, this will translate into weaker earnings growth as we get into next year. So again, markets have not priced in substantially weaker earnings, and that still has to come here. So again, don't overreact to this. This is certainly kind of bearish in nature. Let the markets kind of form themselves out. We see head and shoulders patterns all the time that get negated by big rallies. If the Fed came out tomorrow and said, hey, guess what, changed our mind, markets would take off running again, negate this pattern. But right now, just need to be paying attention to the risk. As we've been talking about, markets are oversold here, very oversold on a short-term basis. Use rallies to rebalance risk, raise a little bit of cash, reposition yourself just in case we get into a much weaker month of September as the Fed continues to hike rates. That's 3 minutes on Markets and Money. See you back here tomorrow.